Hey everyone, I want to say welcome to the HX podcast today. We've got a great guest, someone who I've only recently met, but has a tremendous history and track record, Frank Cappelleri of CappThesis. First off, Frank, how are you doing this morning?
Enrique, pleasure to be here, doing great. Really looking forward to talking to you.
Awesome, cool. Well, just a little introduction from how I met Frank. I follow a great newsletter called The Chart Report, which you should subscribe to. Just go and put The Chart Report in your browser and you'll find it. And Patrick over there highlights a lot of great posts from X/Twitter, which is what I call it now. And, Frank's had a lot of great posts on there with technical analysis and sort of insights on the markets. And I reached out to him off of one of them. I said, I love this post. Would you like to be on the podcast? And, Frank's had a great career. He's been on the, he's been in Wall Street for 25 years, did both equity sales and then technical analysis at Instanet, which is, then became part of Nomura, very large firm. We probably almost coincided and almost spoke probably many times. And then a couple of years ago, he launched out on his own with CappThesis, which provides basically the same services he was doing for major institutions, continues to work with institutions, but also works with RIAs and really has produced a product that's very approachable. You don't need to be a technical wonk that's into Fibonacci retracements and, quads and all this stuff. He actually writes stuff, and we're going to go through some of it today that makes sense to me, and I don't have to deal with a whole bunch of Fibonacci crap, and stuff like that. But real quick, Frank, why don't you that's my quick version of your background. Give us a little bit of background of yourself, and then I want to just kind of jump into some of your core philosophies and all that.
Sure. Well, Enrique, thank you very much, and really enjoyed following you on X over the last number of weeks as well, and some people you just meshed with. So I'm really happy to be here. So as you mentioned, started CappThesis in September 2022 after 25 years on Wall Street. Now, I got my start in 1997. And as you recall, maybe not many of your viewers and listeners, but 1997 was a very good job market. And I was applied to numerous research positions on Wall Street, and I got two offers from Smith Barney. One, I was going to be potentially an assistant for the automobile analyst. And as a 22-year-old kid coming out of college, thinking about going to all the auto shows and the fast cars really appealed to me. But in the back of my head, I knew that wasn't going to happen. It was going to be late nights, crunching numbers and spreadsheets, but still a good opportunity nonetheless. The other opportunity was with the technical analysis group, which I really knew nothing about. Remember, pre-internet, so you really had to dive into things yourself to understand what was going on. It wasn't too accessible. But in talking with that group, I realized a lot. Mostly that what I didn't know, which was the market in general. So what they had was two pioneers of the industry, which I didn't know at the time, but soon learned about, and also this huge chart room as well, which had like floor to ceiling charts and a lot of other things in there, which was really appealing. And so I ended up taking a technical analysis position, and that was run by Alan Shaw and Louise Yamada. So again, two pioneers of the industry.
Yamada, she has I think there's a whole bunch of technical signals that are literally named for her. So, that's kind of as big as it gets, kind of Mount Rushmore of technical analysis.
Yes. And the cool thing about that was that they were already in, on Wall Street for 20, 30 years at that point. And so think about the market that we stepped into, 1997, in the middle of the internet run. Right. Yeah. Not close to the bubble yet, but so many people went crazy, as you remember. People quitting their jobs to become day traders, and a lot of other crazy stories of a lot of, typically some traders that never really experienced a market like that. But what I found really interesting about that time was that they really stayed true to their principles the entire ride up, meaning that it was an uptrend, always trying to identify relative strength and staying with the trend for as long as it existed for. And really, what I recall from that time was once a week going to a meeting with them, let's look at the industry groups versus the S&P 500. What was doing better? What was doing worse? Internet stocks, and so forth and so on, kept on doing better. So we basically stuck with that until the very end. And so, I came out of that believing that every stock that was overbought was a great buy signal. It's the only thing I knew, only market I knew.
It was for those 2 years,
That was then I went to Instinet, and so at the time that was one of the quintessential electronic trading firms. They were growing like a weed back then. I joined the technical analysis group, and I joined with a gentleman named John Schlitz, who at the time had just come over from Lehman Brothers, and then he was an over-the-counter trader, so he had a much different experience. And so I went from with a group that would write some pieces once a week and once a month as well, to John producing something every single day for a more short-term point of view and sitting right in the middle of the trading desk, right? So a lot of testosterone-driven 20 and 30-year-old traders who wrote up this entire internet bubble, and I got there the week before the market turned. And so I quite quickly realized that overbought isn't the best thing. But if you think about it, those first 6 years in the business for me just saw the explosion and then the crash and then the comeback from that point. So I stayed there, and a few years later, I became a sales trader, which I spent 16 years with. And again, totally different experience there because I wouldn't say drop the technicals, but my focus was covering clients like yourself, Enrique, and trying to grow the book. And I would say that things changed again after the great financial crisis because, as you know,
I want to add a couple things here for the audience. First off, I think, Frank, you have a subtle point that I'd never thought about. I started as a portfolio manager in '96. And I feel like if you lived from 96, if you were in the markets from 96 through 2004, you got 30 years of market cycles and histories boiled down into half a decade. I mean, you saw the highest of the highs, the lowest of the lows. My first fund, we started 6 months before September 11th, as an example. So, those are those kinds of things. The other thing, just so those who don't know, a sales trader is a position on Wall Street that every morning would interact with the trading desks for funds. So, I had a fund. I was the managing partner and the portfolio manager making the overall investment decisions. We then had traders who I would go to and say, one of them was a great guy named Rob LaFerriere. I'd say, hey, Robbie, we're going to go out. We want to buy 35 basis points of AT&T. And then what he would do is go out and execute that. But what Frank would do every morning is he'd call Rob and say, okay, hey, man, this is what's going on. We're hearing this, we're hearing that, and he would help us execute the trades. Is that a good description of a sales trader for people who are unfamiliar?
100%.
Okay,
yes.
Good.
And so after those calls, you'd have to, of course, keep on informing the traders and working with them. A lot of times you work the trades with them. And so I would put in a few of my, technical tidbits along the way. And then, again, after the great financial crisis, a lot of things changed for many ways. One being that the number of hedge funds got chopped in half or even more so over the course of the next few years. So at that point, it wasn't as easy for anyone, buy side, sell side. And so I started to do more of the content at that point, just really differentiate myself from my competitors and just add, more flavor and obviously more knowledge to my counterparts on the buy side. And so that started with just accounts on my pad and it started to grow to more of my colleagues, clients. And then a few years later, John left the firm and I took over the distribution for the entire firm. So I was basically the firm's technical analyst. I started reaching out to the financial press, trying to grow the brand a bit.
Okay.
So we go until 2019 at this point, and I was doing both jobs. I knew that I had to make a decision at some point. No one was forcing me to, but I just was talking to more portfolio managers, more buy-side analysts who were getting requests.
And sales trading is also a grind, man. That's a job. You got to get up at I don't even know if you got up at 4:30 in the morning or whatever. Yeah, I mean, you guys, you get up super early. You got to read 300 pages of stuff, and then you got to make 30 calls, or that it's not a small amount of work.
You're correct. It's a lot, and knowing that I couldn't give my 100% to that while also doing the analysis. Made a decision to leave that. And, I thought it was a good decision also because I wanted the clients on the trading side to get it full, someone that could devote their full attention to them. And so it worked out very good for both sides at that point. So the last 3 years at Instinet, I worked on the research sales desk for a little bit, and then I was a desk strategist and really started to, do things from a content-driven perspective. Started to develop different reports similar to what we have in CappThesis now, and got a really good understanding after all of that. And talking to my my fellow sales traders, buy side, sales traders, working with research analysts on the equity side, and then talking to the analysts and portfolio managers, I felt like I got a very good sense of what the people that drove all these decisions really found important. And that gave me the the decision and the desire to do this on my own now.
Okay, great. So what we normally do is, again, we go through what I call evergreen content. It's ideas that you could give to a person who doesn't have a background in technical analysis, has some interest in stocks, kind of high level guidance of like, here's the things that are most important. And, it was really interesting this morning. You publish a piece, and I don't know how often you publish it, but you put some ideas out there where you go through, some buys and some sells and everything. And there were 3 ideas in there, and I'm actually going to go to a screen share here. We're going to pull up. And what I wanted to do, what was so cool about the piece you did this morning, and I don't think you did it on purpose, it was perfectly timed for our conversation today, that you sort of hit 3 technical strategies or technical approaches that I think are really valid, because I think there's a bunch that aren't very valid. And, so maybe we'll go through go through these and just discuss them and why you think it's important, how it's setting up. And then this will actually give the viewers something to look for when they're looking at. So the first one of these, and I've got the chart up here, is actually a company that most people will know, Berkshire, Warren Buffett's holding company, huge company. And, I'd classify this as a uptrend, a intermediate uptrend in a stock that looks like it has the potential to break out after a very long period of time, which can be an explosive move. And the chart we have here is actually the 5-year chart. I can move this to the 2-year, 3-year chart if you want, Frank, but maybe just talk a little bit about like what you're seeing in this chart, how you view it, and how you see this as an opportunity, but also kind of come back to core principles, why you think this kind of setup works consistently or gives high probability opportunities for investors.
Yeah, all great points. I would say one of the things about today's report, especially, it gave a good indication, I think, of where we are in the market, where there's been some stocks that have done different things over the last, I would say, 2 months, as opposed to what we saw from October through March, when mostly everything is in breakout mode and making new highs. And so that's why I think it was interesting to select 3 of them that look slightly different, but all have potential upside from here. So Berkshire, of course, very storied history, but I found it interesting, and I started looking at this more closely at the beginning of the year because it was underperforming at that time. And I know that's kind of a setup, Enrique, that you look for, a long-term chart that's oversold a bit and possibly ready to rally, and it did. But since that point, had a spike at the very beginning of the year, and it's been consolidating from that point. So I've had my eye on it a lot because
Can I tell you one quick thing too? We actually, if I recall correctly, at my former firm recommended Berkshire because I look for an RSI below 30. And, I look for an RSI below 30 and then going back above that. And that's exactly what it did in late October. And my view is, if you can find a company like Berkshire that ain't going bankrupt, that's got a gajillion dollars of cash, and you can buy it oversold and it starts to recover, you do that trade every single time. So that is a prototypical HX trader core trade. So we kind of got, we got interested at the same time. So back then, at least, last year, but go ahead and continue.
Sure. And so aside from that, I'm always looking for breakout candidates, and breakout meaning looking for the classical pattern setup, whether that's an inverse head and shoulders pattern, whether it's a cup and handle pattern, or just simply a consolidation phase you can identify. Just putting a rectangle around it is something is fine too. Now, on a side note, there are some sticklers out there, especially on X, Enrique, as you might have seen, that will take issue to anything you put out there in terms of what you're actually naming or labeling a pattern. I don't play that game. What I try to look for is just, like you said, something that is in an uptrend. This is a long-term uptrend, and it's been pausing. And it's been pausing near its highs after a spike. Yep. To me, that's very constructive, and I want to alert our clients that are on the premium service that this is again, setting up to a potential breakout, and also showing on the chart we put out the 3 prior instances since the beginning of 2021, this very similar pattern worked out as well. And so we're still in an uptrend for the market. We're still looking for leaders. And this is one that obviously has done well through the years, but it's very good to identify the times when the probability is in our favor. And that's what we're doing for today.
Yeah. And just to so what I'm going to do a little bit here, I'm going to paraphrase some of the things you said. I think you put it in very, very understandable terms. But a couple observations here. You're basically saying, look, we've got a stock that's been in a long-term uptrend. I can see that in the chart. All this is going all the way back to COVID. I mean, the stock has gone from 172 to 410, and I'm using Berk B here just because I don't want to screw around with Berk A. And stock's consistently gone up. But the stock has basically done it in a stair-step fashion, right? You had a great run into May of 21, and then the stock consolidated. Interestingly enough, as the stock market continued to move much higher, the stock went through this consolidation period, and after a 6-month consolidation, it then spiked higher. Then, with the sell-off in the market, came back down, re-entered into another consolidation period, spiked higher, consolidated, spiked higher, consolidated again. And I think that the way I look at these patterns is I look at stocks as like supply, as a product with supply and demand. Whatever Berkshire's selling as a company, right? Stability, Buffett, quality earnings growth, et cetera. The NAV continues to move higher. People are buying across this 5 years. It's just when they do it, what happens is you get a lot of buying interest, then that kind of exhausts itself. You don't have a lot of sellers because the stock's not going down. But what you do is you have consolidation, but as it continues to accrue more value, then all of a sudden people go, oh, hey, look, Berkshire's, wow, I didn't realize he had 300 billion of cash. And so you're identifying, and then the idea, I guess, and this is actually a real question, is that you believe that this period here, that we've gone from February 24th to here, has the potential to set up like we did in April of 23, or perhaps like we did in December of 21. Is that a good summary?
100%. And I would just add one more thing, Enrique. So getting back to the setups that you like. So I'll look for, in Berkshire, both of those instances where I think you have a very good chance of doing well when it comes down and holds support, and you buy that price flip as it comes out of the support and comes up from oversold territory. But in a situation like this, where it's been this consolidation phase for a few months, then I'd be patient on the other side and actually wait until the breakout actually happens. Because at that point, you can manage risk better, at least from my perspective. You know what the breakout is. If that's a clean breakout, meaning that that breakout zone is not violated, then the upside target, you can use a measure move and look at it that way, and use the point where, the most recent low as a potential stop loss from a trading perspective. That's how I use these.
Okay. Well, so I did a piece the other day about 50-day moving averages, and 50, 100-day, 200-day moving averages, but it has a little bit to do with support and resistance. But my point was, and it's going to kind of feed into what you're saying. I look at it. So it's funny. I think all the technical analysts, they just talk about support and resistance and moving averages, and they just go and say they work, but they never actually tell people why they probably work. Okay, what's the reasoning behind it? And to me, the reasoning behind it is let's just take a 50-day moving average or this big consolidation period here. If you've got a 100-day moving average, this is actually a great point right here. Actually, in the last breakout on November 30th of 2021, the 50, 100, and 200 all met at the same level, and the stock had been flat for 6 months. That means there were a huge amount of people that own the stock recently at those levels, okay? So what happens is if the stock, that becomes support if it sells down to it, because people say, well, I don't want to sell below where I made money. It becomes resistance if it goes up to it, because people will take profits as it goes through it. And so to me, these moving averages and these supports and resistances, they're really just saying, I've got a big cohort of people that own the stock around those levels. And that's why it can be so powerful to either support, resist. And when you break out from it, that's when you generate, incremental enthusiasm. I mean, how do you kind of do you agree with that framework, which is a little bit different than I never hear technical analysts talk about those kinds of frameworks at all. How do you view sort of support, resistance, breakout, et cetera?
Well, I think it's exactly right, because it's who's driving this. It's not the lines themselves. It's the investors or the traders that have created the environment for those lines to actually exist. So I think it's just easy for people just to blow it off and just say there's support there. Sometimes it is, and sometimes it's not. But I think it's much more important, number one, to suggest, Enrique, how you noticed it, how they're together. And a lot of times, if that's the case, they also coexist near an actual support zone, right? And so I think moving averages that support and resistance are much more helpful if you could identify other areas of support around them.
Got it. Okay. Well, so, and I'm going to, for this episode, we're going to do something funny. I'm going to give each of the three stocks that we go through kind of a pattern overview that fits, that should be something investors should look for. This is a long-term uptrend with a consolidation period that you're looking for a breakout that you think will have a continuation period and has the possibility for good short-term profits. And one thing I want to say here, Frank, when I look at all of these things, we always look at it as probability, and I think of blackjack, right? Just because I'm sitting on a face card, or I'm sitting on an 18 versus a dealer 6, doesn't mean I'm going to win the hand, right? But it's a very high probability bet. And what we're looking to do is find high probability bets, be ready to cut our losses if the bet doesn't play through. But if you play enough, 75, 80% bets and you control your downside, you're going to have a very positive NPV, for doing that. But is that a good description of this particular chart pattern that you're looking for?
Yes, 100%. I would just add that I'm sure Peter Brandt, is a very successful technical trader for the last 5 decades, and so he uses classical patterns as his way to profit. And he'll be the first one to say that technical analysis itself isn't anything more valuable than any other form of analysis, but the way he utilizes it, for him, patterns make sense more so to identify where his risk is, right, and to manage it that way. And so he'll just say that a lot of times his win rate on stocks or on trades is actually below 50%, but he knows when to pull the trigger and knows when to let breakouts run, and that's sort of given him the outstanding success he's had over the decades.
It's interesting. Our strategy at HX Trader, which we're going to talk about, something your third one follows that strategy. We have a very high hit rate, but of 75%. But our losers lose twice as much as our winners win, but that still means that we're generating very high performance. Right. Just that very, very positive performance, right? Because my losers will be worse than my winners, but 3/4 of everything I do is a winner. So my slugging percentage. So I'm trying to think of in baseball terms of that slugging percentage, because some people would do the opposite, right? If you only have 20% winners, but your winners go up tenfold and your losers only go down 10%, you could have 2% winners, and it wouldn't matter. Our strategy, actually, our losers tend to lose a little bit more, but we have very high hit rates. So I think it really just comes down to having a strategy that works through time. We need to get Peter on here, by the way. So let's go to the next one. This could not be more opposite in terms of the type of opportunity. This is the 5-year chart on Pfizer. I'm sure everyone's familiar with Pfizer, but obviously with COVID and the vaccines, the stock just had a massive run. I mean, here we go, 27 to 60 in just about a year. And as they made all that great money off the vaccines, well, now we don't really use the vaccines as much / almost at all. And the stock's just been getting destroyed. I mean, it's been a one-way trip down. I mean, we're well below the COVID levels. Talk a little bit about what you're seeing here, and I'm gonna pull this into maybe a 2-year chart to talk about it. What's the opportunity here, in your opinion?
Well, one of the things I think is interesting for your viewers to understand how, someone can come to a conclusion that this is a potential, upside objective here. And one of the things is I do is I'll run screens a lot of times for opportunities. And most of the time, though, they are identifying charts like Berkshire. Right? I'm looking for stocks that have been trading higher, that are maybe consolidating above a rising 200-day moving average.
Trend following also, by the way, because I mean, when you mentioned Luis earlier, you talked about trend following, and trend following with breakouts is a very, that's a core tenet of technical analysis and a core theme of the markets and a great strategy.
Yes, especially in a market like this.
Yeah.
But there are times as well where I'll just go through the S&P 500 or another list of stocks, just down arrow, Enrique, keep on going lower, and you see what comes up. And what I try not to do is sometimes I even look at the symbol because I don't want it to blur what I'm seeing. So I want to be objective as possible. And so for this one, I was just looking at the last 6 months of price action, and I was like, oh, what is this potential bottom? What is this? It looks like to me, a double bottom potentially or something different like that. And lo and behold, it's Pfizer, where there's other ones that don't look as good. And so this is a good point because there are so many times when you just want to bottom fish or people try to, where the stock's been going down, it's down X amount over a certain amount of time. It's due for a bounce.
Well, and one other element in this, and we're going to talk quantamental in a second, which is quantitative plus fundamental. This is a very cheap stock. So, I mean, that's the other thing people go, oh, it's Pfizer and it's down 80% and it's got a ton of cash and like I should be buying it. And they could have said that at 50 and 40 and 30. And here we're just bouncing off at 25. So
exactly. And so people will take issue with this now because it's already up a certain amount from the low. But really it doesn't matter. I mean, if I go back and see the last time it was at this price, the chart looks a lot different than it did on the way down. Because on the way down, it's just a falling knife. And yes, if you bought it then, you hold it now, you're still at the same level. But who's to say you wouldn't have sold it as it rolled over again if you managed your losses? And so this isn't to say that this is going to go, this is not, there's no reason to believe this is going to be like the springboard to get it back to new highs. But the point being is something like Pfizer, with all the negative narrative around them, which you just mentioned, no one's really looking at it from this angle. And I'm not saying I was either, but I do find it interesting that it's quietly come back to its 200-day moving average, which it hasn't closed above in quite some time. And it's forming a bullish pattern at the same time. And its other moving averages are curling higher with it. So to me, that creates a potential opportunity and one that I'm willing to at least put a trade on for and manage risk on the downside, because who knows, it could work out. And this is when it really gets interesting because you see how some of these areas that have come back so well, once you have the first bullish pattern work out, I mean, you have an upside target hit, and that can set the stage to create a much bigger foundation that can then lead to much higher prices. So this could be just step one.
I got to tell you, first off, I fucking hate bottom fishing. It's a terrible strategy. It's just the worst of the worst of the worst. But I might fucking love this idea. I mean, a couple other things just to think about. What I find really interesting, that 6-month chart that you showed, that's just wow. Like, you give me that 6-month chart, I go, wow, it has a great basis. It's about to break out. The other thing is look at this chart on the 1 year and look at the volume that was done in December on that breakdown, and that's where the great consolidation starts. And if we go, and I'm curious here, look at this. I mean, look at the 5-year. This is the 5-year chart. That was a cleanup of some sort. I mean, factually, I'll tell you that's true. The stock stopped going down 6 months ago when you did the biggest spike in volume that you had seen since the COVID periods, because these are the 2 COVID periods. So to me, that screams that, we've cleaned up a lot of the natural sellers. A couple of the things I'd say, it's probably got to be a lot of people underweight Pfizer now. I mean, Pfizer is still a $166 million company, which would make it like number 70 or 75 in the S&P 500. But here's where I'm going to get quantamental, and I know you probably never look at this. We, not meaning never ever, but like we look at the fundamentals too. The reason why Pfizer's gone down is actually this. These are the earnings revisions on Pfizer. Okay. The blue line is the estimates for 2024. I haven't looked at this chart. I haven't looked at Pfizer in a long time. But back 2 years ago, people thought they were going to earn $4.70. Now people think they're going to earn $2.35. But something's happened in that December. In December, that number went from 320 to 230. That's a huge move for expectations, down by a third. We did washout volume, and lo and behold, look what's happened here. Now we've got positive earnings revisions. And if we go to the earnings surprises, this number's kind of garbage because companies always can beat on the earnings surprise, right? Because they'll just guide down, and that's where the EEG. But they've got a history. This most recent quarter they beat. Doesn't suck that the company has a 6% dividend yield. This is really interesting. To get me interested in a bottom fishing candidate, the bar is so high. I mean, it's like to get me to root for a Boston team. They got to be playing against the Nazis or something for me to, root for a Boston team. That's how I feel about bottom fishing. But this one's really interesting. And you identified it with the technical pattern, and that's where technical and fundamental can kind of meet. What do you think about this volume pattern and the contribution, that it would mean to, the potential for this idea?
I think it's a big factor. It just shows interest, and it shows beyond, Enrique, what you were talking about. That's real volume. It's a real washout day, like you said. But now you could have some generalist momentum type chasers, getting involved. And that's when really the complexion could change.
Yeah. Well, that's why I look at those earnings revisions. I mean, I'll tell you this. I'll actually, let's do one last thing here. Stock's got a 5.7% dividend yield. The stock trades at 10 times EPS. The stock has a significant weighting in the S&P 500. If this chart here continues to hold, this is the earnings per share. If they just hit these, that was for the quarter. I don't love that. I would have rather that number going up. But if this annual number stays here or goes higher, this stock could go up 50%, like in a nanosecond, because of the valuation, because of the cash flow. A 3% dividend yield is going up 100%. But you go up 50%. You're talking about let's go back here again. This isn't a style that we do either in any of our things. But where's that long-term support? Remember we talked about long-term support resistance, 35.40. That seems like it's a very logical thing. That's great. I mean, I think it's I do not like bottom fishing, but I think you've identified one, and so again for the listeners, this is a established downtrend that is now consolidated and is on the verge of breaking out. Before, what we had with Berkshire was an established uptrend that consolidates and now is on the verge of breaking out. This is kind of the inverse of that. I would say the first one of these that Frank talked about, I would do those all day long. The second one, I would do 1 out of 10, 1 out of 100. But when they play out, they can play out very quickly. Yeah. How would you put this trade on, or how would you think about putting this trade on?
Well, with this one, I just think you need to see more strength. I want to see a breakout that works. So right now it's, and again, you could just use any type of stop that you're comfortable with, but I would give it a little bit of leeway. We know it's off the lows right now. And so what I try to identify in our reports is I give the suggested stop loss point, the initial one, and then, people want to do more of it, we can have a conversation. But I think something like this, and we've seen this before in other areas. Like, for instance, another area where this could be happening right now potentially is in the solar area, like TAN, solar ETF, right? Nothing but lower lows and lower highs for so long, but it's been consolidating recently just a bit. We saw the same thing happen with the cannabis names at the beginning of the year, where the MSOS ETF was just going straight down, straight down, straight down. Now, recently, been showing signs of life, and that's obviously other factors to go with it. But these are things I think happen when you have a bull market, where people love chasing NVIDIA and everything else, but at the same time, how much more can you? Sometimes you want something different, and so I'm always looking for the next potential breakout that could be, who knows, right? The next one to rotate into.
And our strategy, I call it quantamental, quantitative plus fundamental. We then add what you just did to the earnings revision. So like I can't pull it up on TAN because it's TAN's an ETF.
Yep.
But First Solar is actually quite interesting. That one broke out here, and I think got a lot of attention from a lot of people, which I think is starting to get the attention for TAN. What's interesting about First Solar is look at the earnings revisions on First Solar. Despite the world just being like terrible, they've held in. Look, I mean, that chart's great, right? So the world's been awful for the solar stocks, and look at what they've managed to do, there. Like, take a look at this is NextEra Energy, which has a lot of solar exposure. Actually, that one's held in pretty well because of the utility business. I'm trying to think of another big solar guy. But the charts don't look the same. It's harder with cannabis. But yeah, okay. So let's talk about this last one. This is my bread and butter. This is what HX Trader mostly focuses on. This is a tricky pattern though for this. Okay. Mm-hmm. So what we're looking for are established uptrends. Okay. The fight's fine. It starts in 2022, but the stock's gone from 22 to 80. That's a pretty nice uptrend there. Let's pull up that. We're then looking for the stock to have gone down so much that it breaches the 30 RSI, but recovers. Okay. Now you'll see here that didn't pay off immediately, which concerns me a little bit for my strategy. But what I'm really doing is I'm looking for that setup when I have the following. When I've got earnings growth. So let's look at the earnings growth at Uber. That's amazing. 87 cents to $4. If they actually hit those numbers, the stock's going to the friggin' moon. Mm-hmm. Well, let's look at, beating earnings. I haven't done any of this analysis, so I don't know that. Beating earnings, not so great, but let's actually look at revenue. It's okay, track record, but this is the money chart. These are the revisions. And let's go to, I'll probably go to EBITDA here. I know I'm going out of your comfort zone, Frank, but I think it's interesting to compare the two. Sure. So let's, the earnings there are not great, but let's go look, like I said, look at the revenue. This is what I think powering it. That's what's been powering the stock, but revenue's been stable. EBITDA, that's the stock. Look at the two charts. Okay. Yeah. This is why. Now, what's interesting here, the stock likely sold off, was May 8th, and they reported a number that on the revenue side beat by only a little, and the stock got hit. And then that's probably really when, the market's also been consolidating, that's when you saw this gap down off the back of the market. For us, I'll say this would be a really good candidate for what we do. I don't love. The only reason I don't love is that it's taking its time to recover. This is taking a little bit too long, and I just kind of hate these because I feel like it's gonna, the 200-day has an attraction. Although if it just goes flat here for the next month, you're going to be at the 200-day. Walk us through. So I liked this one because it fits our methodology. I give this a hard 7 in terms of what I would look at. How do you look at this stock? What's what attracted you to it? And this is the month-long consolidation that I'm talking about right there.
Right. So very similar how you look at it as well, where I was always looking at Uber. It got a little ahead of itself and been tracking on the way down. It didn't for about a week or so, and realized that it had gotten pretty far down to its 200-day moving average. And so at this point too, I find it interesting looking at the RSI. I do look for positive divergences in that as well. So now the RSI has been making higher lows. The stock has not yet. And so sometimes you see momentum lead, just showing the downside momentum is waning a bit, which to me, that shows that traders aren't really interested in it right now. But I do think with one of these, especially given the name, if you do get one big day near that 200-day moving average, that can actually attract some more demand. So I think this one is very good to put on someone's radar screen because sometimes you don't realize that some of the high flyers, you just think everything is to the stratosphere right now, but some have come down pretty hard. Now,
honestly, most have come down because I do this. This is all I look for. There are a ton of names. Like, there are very few that have maintained those March, April highs. I would say if you took, and I might run this analysis, if you took all the stocks that were up the most through April 1st, I would bet you that 90% of them are lower than they were on April 1st.
I would agree with you. Just the other day, I ran just a quick study right before things turned when technology rolled over last week. In May, or I guess at the end of May, was that a third of the S&P 500 were making new 20-day lows, right? As the market was moving higher. So this is one of them, probably more or not as many, but a good amount making new 50-day new lows as well. So yes, there are a number right here, which I think could bring into another discussion where it's a ripe for rotation, whether it's within technology or outside of it. And so many names have gotten hit on the way down where technology and the biggest names have stayed higher. That's why I think that over the last few days, when technology's gotten hit, that so many other areas were able to absorb that. So I think we probably need to see that going forward too.
I had forgotten what I loved about what you wrote with this is that was this divergence with the RSI. So, what's interesting here, this stock has done nothing but, look, the stocks technically, it hit a high on March 21st, and it's done nothing but basically go down for 2 months. That's a factual statement. And even after it breached this RSI oversold, it continued to go down a little. But if I'm going to play with this some more. I like what you did with Pfizer. Is I just say, let's just take a look at a month here. Well, on a month chart, and if I cheat a little bit, okay, that's not so bad, right? And you've got this positive divergence here, right? The first time it went under the RSI and recovered quickly. It's treaded water since then. But even then, that's a funny thing is like right here where it did my RSI signal. The stock was on 5.8. Or maybe this is this bounce date. I guess the stock closed at, stock was at 65. The stock's at 65. So basically it's done nothing. But then when it triggered it here, you're 65, but now you're beginning to see the RSIs you've worked. This says to me that these two tests here of this, my RSI buy signal and then a stabilization of the stock say to me that we've kind of washed out the marginal seller, but that divergence is really fascinating to look at. Okay.
Right. So I actually wrote about this one last week, and I kind of paused as well. I wanted to see how it did near that because I identified the same thing, just knowing it was oversold, didn't respond to it, but now it's flatlined, which I think anytime you see that type of thing after a big move, I always ask myself, is it a failure to go down or a failure to go up at this point?
Yep.
Well, it's like the Bears got what they needed, but you needed one extra push down to really break it, I think. And who knows, they may come at some point, but looking at areas like this, especially high-profile names that really haven't been in the news recently or people haven't talked about as much, I think are just interesting, especially when the technicals line up like this.
Yeah. Well, look, let's do a quick review here because I love this. We almost never, honestly, on this podcast talk about situations that are happening right now. It's just not what we do. I want this podcast I want some people to watch this in 2 years, 3 years and be like, there's lessons to be learned. This one lines up perfectly though. Look, 3 setups that work very well. A long-term uptrend with consolidations that when it breaks out, you want to pursue it. That's what we had with Berkshire. A long-term downtrend with consolidation that now has shown, a period of stability and beginning to also potentially break out. And then, our core trading strategy, which is a long-term uptrend that has, that gets materially oversold shows some recovery and a mean reversion as opposed to a breakout from those three. I think these are all three great classic patterns these patterns will probably be around long after you and I are still doing this, Frank. So
let's hope so. Sure. That's why they work now, right?
So let me ask you, we did this one a little bit different, but if you we're gonna finish here in the last 5 minutes with this following question. So, you're at Thanksgiving dinner, you're at a cocktail party, whatever it is, and your second cousin walks up to you and goes, "Hey, you talk to him sometimes, you talk baseball with him sometimes, or whatever." He goes, "Frank, I just got, I just moved jobs and my IRA has been moved over. And so now I got off my 401k and now I can trade. And, I put $100,000 into an account, and I've got all my other money, put with a advisor, things like that. But, I'm interested in this. I'm interested in learning. Are there three things that you would say to him or her? It could be just one thing. It could be six. But if you had to kind of give, say, okay, and I'll give you the one that we use a lot, plan the trade the plan, okay? Which is make sure you got an idea of what you're doing, why you're doing, and what you're going to do as it develops. And then for sure as hell, make sure you do that when it develops, because that's where people mess it up. What sort of advice, mottos, a couple would you give to someone in that situation?
Sure. I think the number one thing is whatever strategy you pick, I'd be committed to it, right? And It's all about setting some rules and paying attention to them. Now, that rule may be never trade. Right. Okay. I believe you mentioned that one time, right? Either trading all the time and don't trade at all. That's one of your
trade a lot or
right?
don't trade. Trade a lot or don't trade at all. Don't get caught in the middle. Yeah,
exactly. So for most people, being market agnostic is much better off. You put something into play, automatically put it in. You're buying at the top, buying at the low, and over the course of the next few decades, you'll do okay. Knock on wood. Other than that, I think it's it's almost impossible to remove emotion from this, because you can go at any point. Whether it's CNBC, logging on to your favorite internet site, so forth and so on, you're going to get flooded with information. So I know we didn't talk about this, but one book I really felt turned that completely off was How I Made $2 Million in the Stock Market by Nicholas Darvis. I'm sure you've heard about that one. This was
I haven't actually, but that's
okay. Very corny title, but
I'm going to order it on Amazon right now.
Yeah.
What's it called again? How I Made
$2 million in the stock market. And so the basic premise, it follows a gentleman who was a professional dancer in the 1960s who got involved, interested in the stock market. But because he was traveling all over the world, and remember, 1960s, didn't have any access to anything live. He was following the market and realized that, stocks move in patterns. And so what he developed was a trading strategy that identified when stocks would base and then break out, base again. They all would just form boxes. And the most interesting part of it was that he had to create these patterns himself by looking at the stock tables that he find from the local newspaper that was always taking place outside of.
This was written in like the 1930s or 1940s, right?
I think it was 1960s. It was around.
Okay.
Because that was actually as you know a good bull market, so the strategy worked well in. But the thing was, he did all this analysis when the market was closed. So he'd cable into the stockbroker and say, if the stock was here, buy it. If it goes below this point, sell it. And so that particular thing shows you that you can do well. Again, the market helped him, but without any real-time data. And a lot of times I'll do my analysis outside the marketplace. All those three names, those were always last night, looking at things and not worrying about what there's going to do today or yesterday. What does it look like right now with no emotion?
I agree with you. I mean, you made another point earlier too, is that I inevitably know what the company does, but I do 6 screens for HX Trader and I don't really care about the ticker, because sometimes what I'll do is I'll be screening for an RSI around 30. I get companies that I don't know. I mean, I've been doing this a long time, but I'm looking at the Russell 3000. I get companies I got no idea what they do. And I will tell you, some of my best ideas, because at Empire, we actually had a software that would identify these setups. We're redeveloping that software. Some of my best trades, and I would have periods of like 3 months at a time, where almost every trade was some company that I kind of have heard of, but hadn't really heard of, and then would do that trade. And I didn't need to know what the company did. All I needed to know was the technical setup, the earnings. I usually went in and made sure to make sure there wasn't like, some nuclear accident or something, so that I wasn't missing something, painfully obvious. But okay, so your first one, you said was kind of very similar. Plan the trade and trade the plan.
Yep.
The second one is kind of similar to mine. Trade a lot or don't trade at all. The third one I'm going to kind of say is tune out. Try to really do your best to focus on your plan. Focus on your strategy and get rid of the noise, because the noise. The first one's going. The first one that we talk about, plan the trade the plan is going to fail. The trade the plans part is going to fail if you're too distracted by the noise. I can't wait to read this book. I'm so excited. Okay. Any final words that you want to share? And then we'll go through a couple other housekeeping things.
Sure. I would just say with anything, just be consistent, right? That goes for any of your younger viewers that are working at Wall Street or someplace else. So, I started writing about the market decades ago, when a lot of times, a younger trader or assistant would come like, I want to do some content. I have all these ideas. It's a good day to have all these ideas, but you got to make sure when you put something out like that you can do it in a consistent way that your viewers that want to hear what you have to say, see it and become to expect it from you. If you go over skis in the first 2 months and you can't do it anymore, then you're going to burn yourself out and you're going to almost ruin your reputation for someone who used to provide value. So that's kind of off on a tangent, but I think that's helpful for people. We'll kind of hear all these stories about, everyone making so much money. Just don't worry about everyone else. Focus on what you're doing. It's a long game.
Tune it out. No, I have a lot of experience in the media business. I actually explained it to so many people that are interested in the media business. I said, believe it or not, there's quantity and quality, but to build a media business, the third point is the most important part: consistency. And that's what people don't understand. They get out there and they say, my stuff's great. And I'm like, yeah, and you publish once every 2 months. Who gives a shit? And then I'll have other people that say, oh, I put out, 20 things. And I'm like, but you never put out anything that kind of has a schedule to it. So, I love that. So, everyone, I love what you do, Frank. What I really appreciate about, I get very frustrated with a lot of technical analysts, and I'm picking on Fibonacci retracements here. And and then there's all those Japanese formations that I can't even remember don't have anything to do with Luis. Yeah, like the Zenkus and all that shit. And right. I mean, that's great. It's useless and it's confusing. And I think it's a disservice to most people. Your stuff, it's very straightforward. I like the setups. You can find you're at CappThesis.com. There's some great, subscription. Everyone can sign up for free for some stuff. There's a great 1-year subscription here. You're pretty active on X, Twitter. Are you active on anything else? LinkedIn, Instagram, any of that stuff, or is it mostly on X?
I was LinkedIn and YouTube right now.
LinkedIn, YouTube. Oh, that's right. Yeah. I forgot. You've got a great YouTube channel. You're very active there. So, thank you, Frank. I really appreciate it. Please, everyone, check out Frank's stuff. He gets my highest endorsement. And he gets my highest endorsement for the following reason: is he does great work, but he does great work that I actually think you'll be able to understand and use. Because I got a bunch of technical guys that do the awesomest work ever, and I just sit there and go, I can't deal with this. But Frank's stuff, I'm like, it's spot on. It's really easy to understand. Again, appreciate your time, and we'll and want to thank everyone for joining us here on the HX podcast, and we will see you soon.
Okay, thanks so much. Appreciate it.